Okay. Good evening and welcome to our PM class this evening. Okay, let me share my screen to usher us to the start of the class. Okay, here you can see my screen. Okay, so before we start, I would like you to go to the chat room and type that you can see my screen. That's the main thing. I want you to type that you can see my screen. If I get that, then I know it's my cue to start. Also, I would like you to show your videos so that I can see you if it is possible. Thank you, Chiamaka, for seeing my screen. Okay, so now our topic for today is marginal costing versus absorption costing. You know, the last week we started this class with absorption costing versus activity-based costing. And so we said that absorption costing and activity-based costing are full costing method. So the knowledge we gained from absorption costing in the previous lecture is what we will be using in this lecture. As a way of reminder or a review, we said that when we're doing absorption costing, we think of a halfway house that is a noun, and we usually use a department or manager, most especially a department. And we directly allocate the variable costs. For the fixed cost, we use something called overhead absorption rate, whereby we look for that rate in relation to labor hours. And we also did something called over and under absorption. That was what we learned in absorption costing from the last lecture. While in ABC, which is the activity-based costing, we talked about cost driver rates. And it is being driven by activity verbs as against noun for absorption costing. Today, our focus, please, when you join in, don't on your audio, just your video is what I need. Okay, all right, so if you would like to show me your video, I will be so happy to see you so that I will know you are paying attention from the look on your face. All right, so our focus for today is marginal costing as an alternative method to absorption costing. And so we are going to be seeing how we can write profits or income statement using absorption costing method and marginal costing method. Okay, now the absorption costing method is what the financial accountants use to write profit statement. Now, the marginal costing method is what the cost accountants or the management accountants use to write budgets, to plan ahead. Why the financial accountant is recording historical events using margin and absorption costing. The management accountants write futuristic profit statements, which is budgets, using the marginal costing method. Now, what is marginal cost? Marginal cost of an item is simply the variable cost of the item. So when we talk about marginal cost, we are talking about variable costs. So it means that marginal production cost is the sum of direct materials, direct labor, direct expenses, plus variable production overheads. So you see here that when we say direct materials, direct labor, and direct expenses, we know these things as prime costs. So we simply say add the prime costs with the variable production overhead. Then you would have gotten marginal production costs. What about marginal cost of sales? So you see, there's a difference between marginal production costs plus marginal cost of sales. What is marginal cost of sales? Marginal cost of sales will be your marginal production plus other variable overheads, which are not production. Okay, one thing I omitted here is that you may want to less marginal closing stock. You may want to less marginal closing stock to get marginal cost of sales. We're going to see all of this when we do an example. Now, for a service company, marginal cost of sales will be your direct material, direct labor, direct expenses, plus variable overhead. So there is nothing like production overhead there because there is no production, you are just doing services. Now it seems that marginal costing is going to be a very useful costing method for management. And so let's look at the uses of marginal costing. What are some of the uses that we can have from marginal costing? Now, marginal costing is an alternative method for absorption costing method. And so in marginal costing, fixed production overheads are not absorbed into the production costs. You know, in absorption costing, we have both variable and fixed production overhead in the production costs. But in marginal costing, you will not include anything fixed costs. And so the fixed production costs will not be included. And so what are some of the uses for marginal costing, despite the fact that we will not use fixed costs? Okay, there are several reasons for using marginal costing. One, we want to measure profit or loss as an alternative to absorption costing. So there's a way you can get your profit and loss using the marginal costing that will help you to get certain variables, certain parameters to help you to get your profit or loss position. Okay, so marginal costing can also help you to forecast future profits. So you can forecast how much your future profit will be. Okay, so we can also use marginal costing to calculate the minimal or minimum sales volume that must be sold before we make a profit. Now we call that CVP, cost volume analysis, cost volume profit analysis, or we call it the break even sales. So marginal costing can help you to do break-even analysis. This is something that absorption costing cannot do for you. It can also be used to help management make decisions. Okay, some of the management functions are planning. And so for planning, you see things like budgeting. Budget is a planning tool. So you make a budget. For example, you must have budgeted for your ICANN, and part of your budget for ICANN is to attend this lecture and also to keep funds to pay for your exams. So that's budgeting, planning. So budgeting is a planning tool. We have forecasts. So you can say your ICANN, you want to forecast how will your PM be? What's your likely score? When you follow this lecture closely, what is your likely chance of passing PM? That's a forecast. Okay, so in management, you can forecast what your sales could be using marginal costing. And then decision making. You can decide to make a product, or you can decide to buy the product parts. Instead of making it, you can decide to consult, give out manufacturing of your particular parts to a consultant. You can decide to sell a particular volume of stock for you to make a certain amount of profit. So these are decisions you have to take as a manager, a production manager. Now, what about the assumptions of marginal costing? What are some of the assumptions in marginal costing? Okay, now, for the purpose of marginal costing, the following assumptions are usually made. One, every additional unit of output or sale or every additional unit of activity has the same variable cost as every other unit. So in other words, the variable cost per unit is a constant value. Now let's see an example of this statement. If I buy a piece of egg, let's say egg is material I want to use for my production, and a piece of egg cost me 100 naira. Okay, so if I have 10 pieces of egg, I must have spent 1,000 naira. If I want to buy an additional 1 unit of egg, I will still spend additional 100 naira. So it means that any additional output will cost the same as every 1 unit of the same output, which means your marginal cost is your variable cost. Now, it means that variable cost is constant when you are measuring it per unit. So 1 piece of egg is 100 naira per unit. It's constant. It's constant. But now, if you are looking at variable costs in totality, variable cost varies. So that's where the name came about. Variable cost varies in totality, but it is constant in per unit. So 1 piece of egg, 100 naira, that's constant. And so if you want to buy 10 pieces of egg, we're prepared to spend 1,000 naira. If you want to buy 100 pieces of egg, you're prepared to spend 10,000 naira. And so it varies according to level of production or level of sale. So you see, variable cost derives its name from the totality of value. It varies when there is a varying level of activity. Now look at fixed cost. In marginal costing assumption, fixed costs are costs that remain the same in total in each period, regardless of how many units are produced. Now you see that fixed cost is acting in the opposite direction as variable cost. While variable cost it varies in total terms, fixed cost is fixed in total terms. Now, if you are to make one piece of bread or one loaf of bread in a factory that you paid maybe 100,000 naira as your monthly rent, 100,000 naira, and for that month you decide to make just one piece of bread, your fixed cost of 100,000 naira remains. If you decide not to produce, you will still make that cost. If you decide to produce 10,000 loaves of bread, you are still going to make that cost. And so in total term, fixed cost is the same, is fixed. That's where the name came about, fixed cost. Now, like we said in variable costs, that they vary in total term, but when it comes to per unit, they are fixed. Fixed cost is the opposite. Fixed costs are fixed in total terms, but varies in per unit. And so it means that if you rent a factory for 100,000 a month and you produce 100 loaves of bread, you mean that if you want to share the fixed cost according to the number of loaves of bread you made, it means you'll be making 1,000 naira each for each loaf of bread. If you are to produce 2,000 loaves of bread instead of 1,000, that means you'll be sharing 500 naira each for each loaf of bread. So you see, in per unit, fixed cost varies, but in total terms, fixed cost is the same. Now, costs are either fixed or variable. Cost is either fixed or variable. And there could be a mixture of fixed and variable costs. So some costs could be mixed, some costs could be fixed, some could be variable. Now, when they are mixed, it's important that you separate this mixed cost and bring out the variable cost element out of the from the fixed cost element so that you can separate them into variable and fixed. And there are two methods that you can use to separate mixed cost into their fixed and variable cost components. We call these two methods. One of them is the high-low method, and the other one is regression analysis. In a future lecture, we'll be talking about how to separate these costs into their variable and fixed elements using these two methods. But for now, let's concentrate on the assumptions of marginal costs. Now, the marginal cost of an item is the extra cost that will be incurred by making or selling one extra unit of the item. So if you are usually selling 100 loaves of bread, what is the extra cost it is going to cost you to sell or to produce 101 loaf of bread instead of 100? It's simple. It's the variable cost of one unit. So your marginal cost is your variable cost. Therefore, marginal costing is particularly important for decision making as it focuses on what will change as a result of a decision that you are going to take. If you are used to produce 100 loaf of bread and you want to reduce it to 98, what will change? If you want to increase it to 105, what will change? So normally the fixed cost will not change, but the variable cost will change. And so you see, in marginal costing, variable cost is sitting as a queen. It is very important. Variable cost is the queen of marginal costing. Now, since we know the queen of marginal costing, who then is the king? Who is the king of marginal costing? Now, let's introduce to you the king of marginal costing, contribution. Contribution is the key concept in marginal costing. And so the major difference between the style of reporting of absorption costing and the style of reporting of marginal costing is the showing of contribution. Contribution plays an important role. So everything you're going to do in PM, everything you're going to do in decision making, you're going to be seeing the words contribution. Now, what is contribution? Contribution simply means total sales revenue minus total variable costs. Or you can simply say sales revenue minus marginal costs. So that is how you get your contribution in total terms. Now, coming to contribution per unit is simply equal to your selling price or your sales per 1 unit minus your variable cost per unit. So that is your contribution per unit. Now, fixed costs are a constant total amount in that period. So if fixed cost is total amount fixed for that period, in order to make a profit, an organization should target their contribution to be higher than their fixed cost. And so if your contribution is lower than your fixed cost, you are going to make a loss, because normally your profit is simply your total contribution minus your total fixed cost. And so if your contribution is equal to your profit, to your cost, if your contribution is equal to your fixed cost, that means your value of profit will be 0. That is what we call the break-even analysis, when your total contribution is the same as your fixed cost. It means you made no profit. But when that means also that your contribution has exactly covered your fixed cost. So when your contribution is now in excess of your fixed cost, you start making profits. All right, so now that's the concept of contribution. That king is contribution. Contribution has 3 formulas. 1, sales minus variable cost, selling price minus variable cost per unit, or profit plus fixed costs. There are other formulas for contribution. We'll get to see them in due time. Right, so how do we write a report, a profit statement? How do we write it using marginal costing? You know, when we were doing absorption costing, we saw how we wrote a kind of report using absorption costing. We'll still look at how to write a report again using absorption costing, but now let's see what are the things we should do when we are writing a report using marginal costing. Total contribution minus fixed cost method. Now, profit is measured by comparing revenue. Normally you have your revenue and cost of goods sold in the period. So your revenue minus your cost of sales, that will give you your gross profits. Then when you have your gross profit, you now deduct other expenses, which is distribution and then selling expenses and admin expenses, then you have your net profit. Okay, so the cost of good is the total cost of all production costs in the period adjusted for the inventory movement. Excuse me. The inventory movement is the movement of opening and closing stock. So that's for absorption costing. Now, in marginal costing system, the opening and closing inventory is usually measured at marginal costs. Now, what does it mean to measure opening and closing inventory at marginal costs? It means the fixed cost elements of production will never affect the opening and the closing stock. When we see an example, you will see what I really mean, that we will be comparing absorption costing with marginal costing. You will see that production fixed costs will affect the closing stock and opening stock in absorption, but it will never affect that of marginal costing. Okay, so when measuring profit using marginal costing, it is usually important to identify our contribution. That's the key. And then subtract the fixed cost directly from total contribution. So that's how we do it. Now look at example MCO1. It shows you how we write a typical statement using marginal costing. First, you have your sales, which is your revenue. This one is 360,000, is there in the second Naira sign. Then you have your direct costs. Now, these direct costs could be direct material, direct labor, direct expenses. We call them direct costs. Here it is given to us as 105,000. Then we may have variable production costs. This is variable production cost, which may not be direct. So this is variable indirect costs. So we may have indirect material, which are not traceable to the final product, but they are variable. Okay, yeah, it's 15,000. Then there is variable selling and distribution costs. Now, this variable selling and distribution cost could be maybe the cost of delivery, maybe the cost of also wrapping, maybe one each bread. Let's say you are producing bread. Each bread you sell, you put it in a special nylon bag. That's a selling and distribution. Or maybe each loaf of bread you put a souvenir. That's a selling and distribution cost. Okay, then when you add all these variable items, you get your total marginal cost of 130. It is this total marginal cost that is your total variable cost, which when you remove it from 360, you have contribution, total contribution of 230 Naira. Then you have your fixed costs. This fixed cost could be your production fixed cost. Remember, in marginal costing, production fixed cost is treated in the fixed cost area. Whereas in absorption costing, when we have cost of sales, production fixed cost will go along with production. But here, attempt is made to separate variable costs distinct from fixed costs. And so in this fixed cost, we may have production fixed cost there, selling and distribution fixed cost is there, administrative fixed cost will be there. So all of them together form your total fixed cost of 150. And when you less it from 230, you have a profit of 80,000 Naira. So this is a typical example of how you prepare your profit statement using marginal costing. Now let's look at total contribution, and contribution per unit. Now, in marginal costing, it is assumed that the variable cost per unit of a product or per unit of a service is constant. We said in per unit term, variable cost is constant. Now, if the selling price per unit is also constant, yes, selling price does not usually change. So if the selling price is constant, the variable cost is constant, then the contribution that is earned from each sale, which is the contribution per unit, should also be constant. The selling price is constant, the variable cost is constant, and so the contribution per unit should be constant in unit terms. Therefore, total contribution can be calculated when we have our contribution per unit. We simply say the total number of volume of sales we made multiplied by that constant contribution per unit. That will give us your total contribution. Now let's look at example MCO2 to see how this work. Now, a company manufactures and sells two products, A and B. Product A has a variable cost of 6 naira and sells for 10 naira. So that's the selling and variable cost. And product B has a variable cost of 8 naira and sells for 15 naira. During the period, 20,000 units of product A and 30,000 units of product B were sold. Fixed costs were 260,000 required. What is the profit or loss for the period? Now look at this solution here. We have our products A and B. Their selling prices were 10 naira and 15 naira per unit respectively. This is constant. It didn't change. So is the variable cost per unit, 6 naira, 8 naira per respectively. It didn't change. And so when you remove the variable costs from the selling price, you have a constant contribution that does not change. Contribution per unit did not change. 4 naira, 7 naira did not change. So now how will you get your total contribution? Simply multiply your contribution per unit with the volume of sales. We are given the question 20,000 units of A and 30,000 units of B. And so when you multiply, you have 80,000 naira as your contribution for A and 210,000 as your contribution for B. So when you add these two together, you have a total contribution from the two products as 290,000. Now you are given the period fixed cost. Now the fixed cost is not tagged to any product. So you are just giving the total fixed cost. This could be the total factory cost, who knows? And you know, when you're doing your total factory cost, you're not tagging it to A or to B. So this is your total fixed cost of 260. When you remove it from 290, you are getting a profit for the period of 30,000 naira. So we have seen two ways in which we can do our marginal costing financial statement. One of them was seen in MCO1, where they gave us everything in total terms. And so we have to analyze all the variable costs and get one single variable cost and remove it from the sales to get your contribution, total contribution. And then we remove the fixed cost to get a profit. That's one way in total terms. Now in MCO2, we were given in per unit terms, and we got our contribution per unit, then multiply by the volume of each product to get our fixed cost, to get our total contribution, and we less the fixed cost from it, to get a profit for the period. So just note these two things. In a financial statement, income statement, we usually encounter something called opening stock and closing stock. And so in MCO1 and MCO2, we didn't mention stock valuation. What does that mean? We assumed that there was no opening stock and there was no closing stock. We assumed that everything that was produced was sold. And so that was the assumption we made in those two. But it does not always happen like that. Sometimes there will be opening inventory and closing inventory. Now, excuse me, it happens in absorption costing. It also happens in marginal costing. So when we do it in absorption costing, we usually use the total costs to value the opening stock and the closing stock. But when we are valuing it in marginal costing, we use the marginal cost of production, not total cost of production, marginal cost of production. Without absorbing the fixed production overhead, we use that to evaluate our opening and closing stock. We are going to see how this is being done in MCO3. And so let's see MCO3. Now look at marginal costing income statement for the period. Now notice here that there is stock valuation. Now we have your sales. So this MCO3 is an improvement of MCO1 especially and MCO2. Look at your sales here. Total sales is 440. Now, your opening inventory at variable production cost. For now, don't bother yourself how we got the 5,000 we use here, but just know that it is at variable production cost. In MCO 5 or 6, we shall be seeing a question on how this is being calculated. Now, our opening inventory is 5,000 naira. Our variable production cost is what we want to calculate. We have our direct materials, direct labor. Then we have our variable production overhead. Now, when we have that, we add them together from opening stock down to variable production overhead, and we get 110,000 naira. Then we now less our closing inventory. Now, this is at variable production cost. So when we less it, we now have 8,000 naira as our variable production cost. So when we less it, we're having 102,000, which is our variable production cost of sales. So you see, we are talking about variable. We started from variable production costs, opening stock, and production costs. We now less variable closing stock to get our cost of sales, but this is variable production cost of sales. So take note. Then we may now want to look for other variable costs that we may have, like fixed, variable selling and distribution costs. Now, when we add them together, we are having from 102,000 plus 18,000, you are getting 120,000. Now, this 120,000 is your variable cost of sales. That is your variable costs. Now, when you remove 120,000, because you're supposed to remove variable costs from sales, we are removing 120,000. from 440,000, we have our contribution to be 320,000. Now that's your contribution. You now start bringing the fixed costs. We have production fixed cost is here, 120. We have your, sorry, this 120 is supposed to be in the first Naira sign. Sorry, it is shifted to the second Naira sign. It's supposed to be in the first Naira sign. The same thing with the admin costs. Admin cost is usually fixed cost all through, 70,000 Naira. Then the selling and distribution fixed cost. So you see, production could have variable, could have fixed cost. Selling and distribution could have variable, could have fixed cost. So you need to separate them. When I teach you how to use the high or low method to separate production fixed cost from production variable cost, and selling and distribution fixed cost from selling and distribution variable cost, you will understand how this is being done. Admin cost is usually 100% fixed. So you cannot tell me to bring variable admin cost. Admin cost is always fixed. So when you have your 120 plus 70 plus 90, you are having a total of 280,000. That is your total fixed cost. So when you remove 280 from 320, you have 40,000 Naira as your profit. This is a typical income statement using the marginal costing method. We shall take one more of this kind of thing and see how it has been done. Now, let's look at how we can prepare absorption costing financial statement, because in the exam, you may be asked to prepare a financial statement using absorption costing or a financial statement using marginal costing. We've seen that of marginal costing. Let's see that of absorption costing. Now, we have your sales here to be 430 Naira, 30,000 Naira. Now look at your opening inventory at full production cost. Now compare it with what we have here, opening inventory at variable production cost. So you see here, this is full production cost, which means fixed cost element is located in this full production cost. Fixed cost element is there. Now look at production costs. Production cost, we have the direct material, direct labor. Then this is production overhead absorbed. Now this production overhead absorbed here is a combination of your variable production overhead and your fixed production overhead. And so when you add everything here together, you have 198. When you now less the closing inventory, now at full production cost, you are having 14,000 there. That means your full production cost of sales is 184,000. Then if you want to know whether you have over or under absorption, how do you check that? Your production overhead absorbed, you absorb 100,000 Naira. That is your production overhead absorbed. But what about the actual production overhead incurred? I told you last time, I'm budgeting for 100,000 Naira for the month. That is what I have put in my financial statement. But on actual spending, I found out that I spent 95,000. That means I have over budgeted for that month by 5,000. That means over absorption is 5,000. So you add that to this, you have 251,000. So you now remove your selling and distribution cost, which is 178,000, and you have a profit of 73,000. So you see how the absorption costing method profit statement is being written. Okay, so let's go further. Calculation of marginal costs profit. Calculation of marginal cost profit. How do we calculate marginal cost profit? Now we are going into the nitty-gritty. We are going into the main calculation now. They said the following example illustrates the calculation of marginal cost profit and absorption cost profit. First, let's take a look at marginal cost profit. Look at this question. Makurdi Manufacturing makes and sells a single product. Now, the selling price for the single product is 150 naira per unit. Variable costs, we are told that direct material units cost you 35 naira, direct labor cost you 25 naira, variable production overhead cost you 10 naira. When you add all of them together, you are having marginal cost per unit used in inventory valuation, 70 naira. So this 70 naira is what you use to value your opening stock and your closing stock. Take note, all the elements that form that 70 naira are all variable items. So there is nothing fixed there. The production overhead there is variable. Okay, now look at the fixed cost information. Budgeted fixed cost of fixed production overhead is 110,000 naira per month. That means for every month they have budgeted, this is what they have absorbed. This question is not going to ask you to do under or over absorption here. Now, the following actual data relates to July and August. Now, can you see that your fixed production cost is 100,000 naira, 110,000 naira for each month? So it corresponds to what has been budgeted. So there is no over or under absorption here. So the two are the same for each month. Now look at the exciting parts. Production unit is 2,000 here and 2,500 here in August. Whereas sales is 1,500 and 3,000. What does that tell you? It means that you will have stock movement, stock variation, beginning and ending opening stock and closing stock. So they made this statement. There was no opening inventory in July. So what it means is that our opening stock in July is 0. That means there is no opening inventory at the end of August. Okay, that means there is no closing inventory at the end of August. How do we know? Now, if you look at it, we had in July, we had 2,000 units produced. In August, we have 2,500 units produced. So when you add 2,000 to 2,005, you have a total of 4,500. Now let's look at sales. In July, we sold 15 units. In August, we sold 3,000 units. When you add them together, you're also having 4,005. That means in August, there was no closing stock. Now, what does it mean? It means that for July, we may have a closing stock in July. How do we know? If you look at it seriously, we produced 2,000 units in July, but we are able to sell only 1,500 units. It means that 500 that was produced was not sold. That's your closing stock for July. How do we evaluate that closing stock? And mind you, the closing stock for July becomes the opening stock for August. So we have 500 coming from July to join this 2,500 in August. So 2,005 plus 500 is 3,000. So the 500 is opening stock valuation in August. And since we sold 3,000, exactly what we had, there is no closing stock in August. Let's go. It says here, required. Show the profit statement for each month using marginal costing method. So we are going to show the profit for each month using marginal costing method. So let's get to our solution. Let's get to our solution. And here lies our solution. The sales for the month of July, we were told that selling price is 150 naira, and we sold 1,500 units. And so that's what we did. 150 times 1,500 units gives us 225,000. Now let's less the variable cost for the month. Opening stock, there was no opening stock, so you see it here as 0. Direct materials, we were told that direct material is 35 naira per unit, and for July we produced 2,000. So 2,000 times 35 is what we did here. 2,000 times 35 will give you 70,000. For direct labor, we used 25 naira times 2,000. So that's what gives us 50,000. Now coming to production overhead, we did 10 naira multiplied by 2,000. So that's what we did. We have 20,000. So when we add everything here, we are getting 140,000. Now we want to less our closing stock. Remember, our closing stock is 500 units. How did we know? We produced 2,000 units, but we are only able to sell 1,500. So 500 units is left. How much are we valuing it? We are valuing it at what constitutes your closing stock amount. You produce with material 35 naira plus 25 naira, labor plus 10 naira variable overhead gives you 70 naira. And that is this 70 naira that was said is going to be used in valuation, inventory valuation. So 70 naira. So all of this here represents 70 naira multiplied by this here, which represents 500, gives you 35,000 here. So this is your closing stock. When you less this closing stock from this figure here, you have 105,000 naira. This is your variable cost for the month. Now, how do you get your contribution? You simply less it from the sales, and you have 120,000 as your contribution for the month. Then your fixed cost. We were told that the fixed cost here is 110,000. So we throw it into the question, from question to the solution, 110,000. So when you remove it from 120, your profit for the month is 10,000 naira. So you see here, it is not difficult for you to produce a marginal costing profit statement. It's not difficult. Okay, so let's look at oops. Okay, let's look at August. Sorry, it was not ended. Let's look at August. Now, for August, we just only looked at July. Let's look at August. Now, August, we still have the same selling price at 150, but we sold 3,000 units. So that's what we did here. 150 times 3,000 units, which gives me 450,000. And that's fine. Now, less variable cost for the month. We'll start with opening stock. That is cost closing stock from last month. From last month, we had 35,000. So it is this 35,000 we had here, which was 500 multiplied by 70 naira. That is what we brought in here. Then our direct materials, since we produced 2,500 units, we are going to use 35 naira multiplied by that. We got 87.5. Then our direct labor is 25 naira multiplied by 2,500 units, and that's the figure here, 62,500. Variable production overhead is still 10 naira multiplied by 2,500 units gives you 25,000. So when you add everything here, gives you 210,000. It's now time to bring your closing stock. Your closing stock. We sold 3,000 units, but we produced 2,500, and we had 500 from last month, making it 3,000. So we had no closing stock. But assuming we had a closing stock, we would have valued it at 70 naira. So we will not look at, there's a 70 naira here already. But here, which is already, this is already a finished goods. Now, why we will not use 70 plus this 70 to make 140? Because this is another finished product, is the addition of direct material, direct labor, and production overhead. Is an addition of this that gives you 70 naira, which correspond to what we have here. So it is 70 naira, like we said, used in valuation. So 70 naira multiplied by 0 will still give me 0. So that's it. So your variable cost for the month is 210 minus 0 will still give me 210,000. When you less it from 450,000, which is in sales, you have 240,000 as your contribution for the month. Then your production cost is 110,000, and when you less it, you have 130,000 as a profit for the month. So it's not difficult. It's so easy for you to produce your financial statement using marginal costing. I want you to go through these examples again and again and see how you can replicate this. Okay, so let's look at example 6. Example 06. It says here, it's the same thing. Makurdi Manufacturing makes and sells a single product, the same information. Now, the only difference now is this. This is our 70 naira as before is stated here, but now we now have a fixed overhead per unit, and we are told to see below, which gives you 50 naira. And we are told that your total absorption cost per unit used in inventory is now 120. So you see, we are now using 120 to do our cost inventory valuation, unlike in marginal costing that we use 70. How did we get this 50? Look at it. Normal production units per month. This is what they normally produce in a month, 2,200 units. And they budgeted the fixed production overhead at 110,000. So if they want to make it per unit, they simply divide the 110,000 by the 2,200 units, which gives them the 50 naira per unit. So that's the 50 naira that is thrown here as the fixed overhead per unit. Now, the same thing they told us here for July and for August. The same thing. So the only difference is the addition of that fixed cost of 15 naira. Now, how do we show the profit statement for the month of July and August using the absorption costing method? So we're going to look at them and see the difference between the two. All right, now let's look at the solution. Just like before, your selling price is still 225, nothing changes. Opening stock is still 0, nothing changes. Direct material, same as we did before. Direct labor, production overhead, same as we did before. Now, the only thing that is making everything to change is your fixed production overhead, which we charge at 50 naira. Now, take note. Notice here that direct material cost, we use 2,000 units. Direct labor cost, we use 2,000 units. Variable overhead, we use 2,000 units. But when it comes to fixed cost, we do not use 2,000 units. Do you know why? Because fixed cost does not depend on the volume or the level of activity. So we are going to be using the budgeted level of activity, irrespective of the activity level we have. Even if we produce 3,000 units, we are going to use the budgeted 2,200. It means that, let's assume that this is our factory rent, which is 110,000. They have already apportioned it to the normal average production we produce in a month, 2,200. So it doesn't matter whether you produce 3,000 or you produce 1,000, your fixed cost will still be 100,000, 110,000. So it means that we are not going to be using the variable costs the units produce. Is that normal, that is budgeted? Take note of that. Now, when you add them together, you have 250,000 units. Now, your closing stock is 500 units, but now you are multiplying it by 120. So you see 50 has added 120. So 120 times 500 will give you 60,000 naira. That's your closing stock. When you less it from your opening, from your figure here, you have 190,000. And the profit for the month gives you 35,000. Now, can you contrast this with what we had here in the month of July, which is 10,000? 10,000, your profit is lower here, while your profit is higher here. Okay, let's go to August. Now, in August, the selling price is still the same, but your revenue is also the same. Variable cost for the month. Okay, it's not variable cost for the month I wanted to put here. Less cost of sales for the month. We have opening stock, which is a closing stock from last month. So the closing of 60,000, this 60,000 is what is being carried here. Remember, this 60,000 was valued at 120, and so it is being carried at 120 here. Now your direct material cost, all of these did not change up to this point. It's the same thing we did in marginal costing. Now the difference now is your fixed cost, which is 50 naira, multiplied by 2,200. Irrespective of the fact that we produce 252525, the fixed cost is at 2,200. So when you add everything here, you have 345,000. Now your closing stock, we said it is 0 because this unit is 0 units. Now, of interest to note that this Naira valuation is 120. So 120 times 0 will give me 0. So that's the 0 we have here. So it means that your cost of sales for the month is 345 and your profit for the month is 105. Now let's contrast it here with the profit of August, which gives me 130. Now, what went wrong? What is the difference? Because here we used everything in production, everything they gave us, we used it here in the two of them. Every figure was the same, but we got different profit. What could be the problem? The difference in profit between marginal costing and absorption costing is due to how inventory is valued. Is how the inventory is valued. Now, inventory in the absorption costing, that is the closing stock or the opening stock, includes a share of the fixed production overhead costs. Now, looking at it critically, the opening inventory will contain fixed production overhead that was incurred last period. So if you look at this opening inventory here, which is 60,000 Naira, it contains fixed overhead. It contains fixed production overhead, element of it that was incurred last year. So it is part of it that is apportioned, like we got this 60,000. So it includes fixed overhead that was incurred last year. Okay. Opening inventory is usually written off against the current period. And so therefore, part of the previous period cost is now coming into the current income statement. Don't worry too much about that. The closing inventory contains fixed production overhead that was incurred in this period. But the amount of closing inventory is not written off in this period, but it will be carried to the next period. Now, what is the implication? The implication is where I want you to dwell on. The implication of this is as follows. When there is no change in the opening and closing inventory, like we saw in MCO1 and MCO2, and perhaps in MCO3 and 4, okay, no, MC1 and 2, when there was no opening stock or closing stock, if you do absorption costing method and marginal costing method, you will get exactly the same profit for the two of them, because the difference is usually accounted by checking the inventory. And so when there is no closing and opening, there is no inventory to check, the two of them will give you the same profits. Now, if the inventory position increases in the period, what will make inventory position to increase in the period? That means your closing stock is greater than your opening stock. So if the closing stock is greater than opening stock, that means there will be an increase in stock at the end of the period. Now that increase is usually a credit to the income statement. Whenever there is an increase in the closing stock causing an increase in inventory, it means that your cost of sales, so to speak, is going to reduce. It will reduce your cost of sales. And when your cost of sales reduce, what happened to your profit? Your profit will increase. So take note, when your closing stock is higher than your opening stock, it means inventory position will increase. When inventory position is increased, your cost of sales is reduced. When your cost of sales is reduced, your profit will increase. Now, the increase will be bigger under absorption costing than in marginal costing. So let's see how it plays out here. How it plays out here in July. How it plays out here in July. So when we are using marginal costing, the increase is usually bigger. And so, sorry, yeah, the increase here. Okay, so sorry. Hold on. The closing stock here is big here, and it reduces your cost of sales for the month so much. It increases your cost of sales and reduces your profit. But here you see here, your profit for July happens to be 35,000. But just note that each time you have an increase in your revenue position, that means your cost of sales is higher and your closing stock is higher, your cost of sales will be higher, your profit will be increase your profits. It will reduce your cost of sales, sorry, but it will increase your profit. Now, the opposite will happen when your closing stock is lower than your opening stock. So it means if your closing stock is lower, it means there is a reduction in position. And now that reduction is usually a debit in the income statement. It means your cost of sales will increase than usual. When it is increasing, then it will reduce your profit. Now look at the advantages and disadvantages of absorption and marginal costing. Now, as advantages of absorption costing here, inventory includes elements of fixed production overhead. So when you are doing absorption costing, you will see elements of fixed production overhead in it. And this is consistent with the requirements of financial accountants, because in financial accounting, you have to report both the fixed and the variable cost overhead. And that is an advantage for absorption costing. That's why the financial accountants use absorption costing. They want to know the true position of cost. Now, over and under absorption of overhead is useful in controlling the fixed expenditure overhead or fixed overhead expenditure. So when you are having over absorption, it means you've absorbed much more than you are supposed to. It's a control tool so that you will not be budgeting too much. But when you have an under absorption, you know that your budget is too low. So it's use it as a control tool to see, okay, what is really appropriate. So that's one thing, absorption costing is important. By calculating the full cost of sale of a product and comparing it with the selling price, we should be able to identify which products are really profitable and which one are being sold at a loss. So when we are using absorption costing, we will know which product is profitable and which one is going at a loss. Now, what about the disadvantage? Absorption costing is much more complex than marginal costing, and absorption costing does not provide information that's important that is useful for decision making. So the disadvantage of absorption costing is an advantage of marginal costing. The advantage of marginal costing is a disadvantage of absorption costing, and vice versa. So let's look at marginal costing, the advantages. It is easy to account for fixed overhead using marginal costing, because here we are separating the variable costs and the fixed costs. So it is easy to account for fixed costs. Instead of being apportioned, they are treated as period costs and written off in full as an expense in the income statement. And so another advantage is there is no under or over absorption of overhead with marginal costs. And so there is no adjustment in the income statement at the end of the period. That's an advantage. Also, marginal costing is useful for decision making. We are going to see that when we are looking at some of the decision making techniques. You will see how marginal costing is playing an important role. And contribution per unit is constant, unlike profit per unit, which varies as the volume of activity varies. So you see, contribution is king and it is constant. So you can use that as a planning tool, but you can't use profit as a planning tool because profit per unit keeps changing. All right, what are the disadvantages of marginal costing? Marginal costing does not value inventory with the requirements of the financial reporting. Also, there is no reason why inventory value should include, okay, now they did not put fixed cost, so you cannot know the true position of costs when looking at marginal costing. And so using marginal costing to gauge your profitability, to gauge, especially to gauge your selling price, how to determine selling price, you may be misleading, making misleading conclusions. Marginal costing can be used to measure contribution per unit of product or total contribution earned by a product, but this is not sufficient to determine whether the product is profitable enough. You may have contribution per unit, but is that product profitable? No, it may not be profitable. And so there's a need for you to include the fixed cost to see whether there is profit or not. So far, so good. We've talked at length. We've explained the meaning of and the concept of marginal costing. We have calculated the marginal cost of an item from a given data. We have also explained how marginal costs and the concept of contribution are important in decision making. And we also describe absorption costing using some examples. Okay, we also looked at the calculation of absorption cost of an item from a given data. We saw that in MC06. And we compared marginal costing and absorption costing. So you saw how we compare MC05 and MC06 to get what differences in profit existed. So we compared, given the same information using the two, we compared their style, we compared the profit, we compared how the inventory is being valued. So far so good. You have been able to see how marginal costing play a vital role in planning, in decision making, and we are going to be exploring more of marginal costing. So we are going to be using more marginal costing than absorption costing, but sometimes we will use absorption costing where necessary, especially when marginal costing cannot be used. Then we'll fall back on absorption costing. But most times, if marginal costing can be used to do anything, we'll stick to that in PM than absorption costing. So thank you so much for enjoying this lecture today. Next week, next class. Yes, next week is our next class. Next week, Monday, you shall be seeing another topic. Perhaps we'll be seeing how the cost behavior, the marginal and the mixed costs is being splitted into variable cost and fixed cost. We're going to be seeing something like that, and we'll see what other topics we may want to discuss. So thank you so much. And I wanted to use this video as a point to make your revision. Let me also see if I can give you guys an assignment. I told you that you should always, I sent something to you, which is past question treated register. I believe I sent that. So use that to mark your progress. Use that to mark your progress when you solve a past question. Maybe perhaps I will send you an assignment on your WhatsApp so that you can see which past questions treat this topic that we've just done. Thank you so much, and I wish you a good night rest. Have a nice day.